For the last 10 years, UK equity funds have been losing money. Not necessarily underperforming, not lagging, actively losing domestic investors. Year after year, money has been leaving UK equity funds, even in years when the market has done well, like in 2025. In total, around £71 billion has flowed out. And what's strange isn't the number itself, it's how little attention this has received. Because if £71 billion quietly left almost any other part of the economy, we would be talking about it constantly. So in this video, I want to explain what actually happened, why this isn't just an active versus passive story, and why the consequences go far beyond fund performance. This isn't about stock picking, it's about how capital now behaves. Let's start with basic facts. UK equity funds have experienced net outflows for 10 consecutive calendar years. This isn't just one bad cycle. This isn't a temporary loss of confidence. It's a decade-long pattern. Even in 2025, a year when UK equities delivered solid returns, more than £11 billion still left the sector. That matters because performance is usually the first explanation people reach for. But when money leaves in good years as well as bad ones, performance alone can't explain what's going on. Something deeper has changed in my view. And once behavior changes at this scale, markets don't simply revert back. This is where the conversation usually goes wrong. People say this is just active managers failing, that passive investing has won, that fees explain everything. And yes, active funds have seen heavy outflows, undoubtedly. But that's only part of the story, because almost half of the money leaving active funds hasn't gone into passive funds at all. It has left the fund universe completely, into cash, into money market funds, into mortgage repayments given the rate rises. This distinction matters. Rotation means money stays invested. Retreat means investors are stepping away from markets altogether. And that tells us something about confidence, risk, appetite, and trust, not just manager selection. To understand the next part, we need to talk about benchmarks. Most portfolios today are constructed with a global benchmark in mind, which is fair enough. And the UK now makes up less than 4% of the global index. That single fact changes behavior. Because when you buy a global ETF or build a globally benchmarked portfolio, you are not neutral on the UK, you are structurally underweight. No judgment, no politics, just arithmetic. And when millions of investors make that same rational decision at the same time, capital flows stop reflecting opinions and start behaving like gravity. Money doesn't leave because people actively like the UK. It leaves because the benchmark quietly tells them to look elsewhere. At this point, some people will say, does this really matter? After all, overseas buyers can step in. Capital is global, right? So let's slow this down a bit. Persistent outflows reduce demand for UK shares. Lower demand leads to lower valuations. Lower valuations make companies easier takeover targets. Domestic ownership falls, and the market becomes increasingly dependent on overseas capital. This isn't theoretical. We see it in takeover activity in the UK, in delistings, and in the shrinking size of the UK market itself. There is also a second effect that rarely gets discussed. Talent. If UK equity funds continue to shrink, fewer analysts specialize in UK companies. Fewer fund managers build long-term careers in UK equities. Over time, expertise drains away. And once expertise leaves a market, it's very hard to rebuild. Capital markets don't just run on money, they run on people. At this point, a few objections usually come up. One is that this is simply the unwinding of the home bias. UK investors were once heavily overweight domestic equities. But unwinding home bias and abandoning a market are not the same thing in my view. Another objection is that global diversification is rational, and it is. This is not an argument against global investing. It's an argument about second-order effects. individual rational decisions can still produce damaging collective outcomes. Both can be true at the same time. And finally, someone will say valuations don't matter if companies can grow elsewhere. But public markets are about price discovery, capital formation, and long-term ownership. When domestic investors step away, those functions weaken, even if share prices recover. I'm not telling anyone what to buy. That's not the point of this video. The real question is much bigger. What happens to a country when its own investors stop backing its own listed companies? That is the question. This is not a fund management debate. This is a capital markets question, and it's the one we've been quietly avoiding for a very long time. If this video has helped you better understand some of the challenges facing the UK stock market, please consider subscribing for more analysis like this. All the best.